Now, one of those houses, when they start to turn positive, people start to notice. When they start to turn negative, people start to notice as well. DSP Mutual Fund is what I'm talking about. And Sahil Kapoor, market strategist and head of products at DSP Mutual Fund, joining us to discuss just that. Sahil, you've put out a note saying that y'all have turned a little more constructive with regard to Indian equities. Talk to us in this entire fury of uncertainty that we're seeing. What's keeping you positive, or what's helping you turn the tilt towards positivity?
Sure. So if you rewind to about 24 months ago, Indian markets were trading upwards of 25 times multiple, right? Earnings growth was about 20%, 15 to 20% broadly, and the mood was very upbeat. At that time, we were quite cautious because maintaining a 20% growth rate on earnings appeared very challenging, and valuations were also very, very challenging at that time. Fast forward to today. Today, Nifty trades below 20 times multiple. One very important consideration is when you look at, let's say, the top 500 stocks in India, almost about 30% or maybe 1 in 3 stocks in India have ROEs of more than 20%. And we've already seen a slowdown in earnings. I think we are now between 8 to 10% growth rate broadly for earnings. So the missing link for us was, where was valuations, right? And valuations have now come down. Even on a trailing basis, I think we are getting closer to 19 times or lower. And when you go very, very sector and stock specific, I think you'll find about half of the listed universe, 50% roughly, you will find a lot of opportunities where you will get ROEs of maybe 16% or 20% plus. Earnings growth is still the challenge, but at least valuations have come down significantly. So I think that is one of the trigger points. We will take a valuation call here because it is very, very hard to make sense of events and how will they unfold. But buying cheap or buying at below fair value is in our control. I think that is what our call is right now. It's very important to notice that over the last 5 years, 10 years or 20 years, whenever Indian markets begin to trade below long-term valuations, they become one of the better markets to buy. And the reason is that our return on equity or the quality of businesses which are available in India is of high quality, and that makes a lot of difference.
Sahil, I understand that you're trying to say that the valuations are now looking very attractive, but one of the reasons why valuations have corrected is also earnings growth. Which are the pockets where you're going to see earnings growth and hence flows coming in?
Sure. So one thing is that it's not entirely sure where earnings growth will pick up. So our sense will be broadly to look at basket of stocks where valuations, of course, have corrected below long-term multiples. Take the case of, let's say, BFSI or largely the private banks. If you take the top 4 or 5 private banks today, broadly they are trading close to 2 times price to book value. In fact, 1 or 2 large private banks, as of now today, as we speak, trade at valuations very close to the global financial crisis low. Now, we haven't seen these kind of valuations for a very long time. If you look at the numbers, broadly these banks do about 2% ROA, return on assets, and they are levered by about 7 times, 7x leverage. So they can easily do an ROE of about 14 to 15%. And if you buy them at 2 times price to book, and if the ROEs are going to expand at about 14, 15%, I think investors can be rest assured that this is a good place to be in. Even without a re-rating of the multiples, I think it's a good place to start accumulating this sector. So you don't have to worry too much about earnings growth. Even on a conservative basis, let's say currently the credit growth is about 15%. Even if we're to match the nominal GDP growth rate of maybe 10 to 12%, it still makes sense to go over it on this space, expecting better outcomes in the future. So I think it's purely where these multiples are right now. And there are other sectors within BFSI. You can look at housing finance companies, again, beaten down significantly. You can take a look at insurance companies. Outside of BFSI, you will get the same bet at IT companies. So there is a plethora of universe where these bets can be placed.
Sahil, very curious. I want to try and get you a devil's advocate argument with regard to especially the banks. There is a change in environment, especially given that PSU banks are willing to do business at a 1% ROA? Do you believe that this shrinks the profit pool within the banking system, or that argument may not stand because it's cyclical and eventually asset quality issues will crop up within the PSU space? Is that how you're playing this?
So maybe it's possible that there could be some, market share gains. But if you look at the hard numbers, has it happened in the past, today, or in the last 6 months? The numbers don't say so, right? If this was true that a large part of the PSU basket was willing to underprice and therefore take away market share, that should be the resultant factor. It hasn't appeared in numbers. The trend is that large private banks are taking away market share slowly and steadily. Even when you look at the progress in book values, I think it's very, very steady. So, of course, what you said, if it appears in number, then probably it could be a challenge and it has to be revisited. But at least in data, it has not appeared as of today. And second, and more importantly, just 2-3 years ago, many of large private banks particularly were darlings of the market, but they traded at about 4 times or in some cases 6 times multiples. And that is the reason a massive de-rating has happened, although underlying book values have continued to grow at the same pace. So I think barring the longer term trend which has continued in this sector, currently you are getting the benefit of that negative sentiment and of course some amount of business cyclicality which is not in your favor. So that is the possibly 2 ingredients which are allowing you to buy these sectors and ideas at lower multiples.
And how do you look at IT? You briefly spoke about IT there, but what kind of earnings growth do you see from IT? And is there a challenge to revenue growth from AI for them?
Yes, I think there is already, you can see that in numbers, right? Revenue growth has slowed down significantly. Currently, most companies or at least analysts are penciling in between 0 to 3% in terms of revenue growth, which is a very, very low number. Let's say even if you add back inflation, you get to a growth rate of 5 to 8%, anybody's guess. 2 things are very, very important to note. First, I think most of these companies are now trading at about 17 times or lower. If you adjust them for, let's say, FY28 numbers, many of them are at 14 times. So my sense is that they've already been priced for a very, very low revenue growth. Can they surprise on the upside? Maybe time will tell. Second, what are the ingredients for us to know that these businesses are facing hardship? Of course, top line growth is one metric. The second and more important metric is, are the margins shrinking? I think that has not happened yet. Largely, they've been able to manage the business cycle quite well. But maintenance of margins, I think, is another very important sign that probably this is a business cycle which is not favoring them a lot. But if they come out with this from this business cycle, I think their profitability will be maintained. So many of these large IT companies which do ROICs of about 40-50%, if they are available to you at, let's say, 14 times or 15 times 2-year forward multiple or even 17 times trailing multiple, I think there is no harm in trying to, nibbling into these names. They offer wonderful opportunities.
Interesting. Sahil, you've spoken about banking, financial services, insurance, and IT. That's where the pressure has been the largest. And I don't know if this is a conscious call, but FII positioning within those sectors have come off very, very sharply. Do you believe FIs will likely come back to the same sectors? Is that what the real bet is? Is it based on flows or is it purely based on valuations? Anything else that's looking reasonable to you outside of this basket?
So we've written it many times that, flows don't cause returns. So it's not that if FI money or domestic money goes into a sector, that sector will start giving you high returns. I think it's probably, according to us, when you look at the numbers, there is no correlation with that. When you talk about the FIs, of course, I think there are 2-3 ingredients today. You got the rupee, which is at about 90 on rear. I think it's quite oversold. Except 2013 and 2009, you haven't seen rupee at 90 or below rear for a very long time. So you've got a lot of things priced in on the currency also. So when foreigners look to invest in India, most of them come through in a passive format. Currency now, I don't think will be a bigger challenge, at least people who come with a contra lens. And second and more importantly, when you look at valuations, which I spoke earlier, are also significantly in favor, particularly in these sectors. So my sense is, yes, if you look at it from a lens of a foreign investor, this is the time to probably look at India more constructively rather than 12 months ago or 24 months ago. So that, I think, is probably going to be an important consideration. Secondly, outside of these sectors, I think there is still some amount of comfort coming up in some FMCG names selected. When you go bottoms up, they've been completely beaten down. Valuations have come back, and even a very small uptick in consumption could, give or rev up this sector significantly. Some auto ancillary names, some chemicals name. So my sense is there is now a basket where a good portfolio can be created.
Sahil, I know I need to let you go. Is there a tilt, large cap versus mid and small? Is there a preference there?
As of today, the preference for us is large cap. I think small and mid cap are still not there. Probably in time we'll get there.
Okay. Sahil, thank you so much for coming in and speaking with us. This has been a very good conversation to kind of contextualize how you're looking at markets. And you're an important participant which markets look at as well to try and figure out as to what's playing out. Okay, we'll step into another very short break. We'll continue coverage on the other side. We'll talk corporate on the other side of this break. Stay with us.